This week on the VC React podcast, MAGNiTT's latest report, Series A valuations in the UAE and Saudi are back to 2021 highs, while other emerging markets are still playing catch-up. And international VCs now make up more than half of the investors in these rounds. Are we finally getting the recognition we deserve as a hot emerging market, or are we quietly importing a late-stage bubble? Nabta raises $2 million pre-Series A to scale AI-powered women's health platform across MENA and Africa. When every startup says AI, how do we separate AI as a buzzword from AI as a true clinical and operational edge, especially in something as sensitive as HealthTech? And finally, in Saudi PropTech, Ghanem's $7.1 million round in fractional real estate. Is fractional ownership genuinely democratizing access to real estate, or just pulling retail money into an illiquid, hard-to-price asset class? And what's up with sandboxes everywhere? Are they really adding value and trust, or slowing down startups? Let's react. Hi everyone, and welcome to a new episode of the VC React podcast. Every week we bring you insights and reactions from top VCs, LPs, and angel investors reacting to the latest news on startups, funds, and investment rounds. Let's jump into it with our guests for today. Seksek, partner at Sekuity Ventures and host of the AbeZ show. Arnav Danthi, principal at Nuwa Capital. Dina el-Shenoufy, co-founder and general partner at F6 Ventures, and my co-host Jamie Lane from FWDstart. In the video description, you can find more details on our guests, their LinkedIn profiles, and links to their companies' websites. Our weekly news is brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Before we dive in, a quick one. Ever notice how finance teams don't have one right way to work? Approvals in Slack, invoices in email, reconciliations in spreadsheets. That messy middle between contract signed and cash received is where time disappears and money stalls. It's follow-ups, escalations, statements, reconciliations, and awkward nudge that turns into a chase. Most automation tools tell you to change your process to match their product. Okta does the opposite. It learns how your team already works and makes it faster. No major changes, no heavy retraining. From the minute a deal closes, Okta's AI agents spin up invoices, schedule and personalize follow-ups, reconcile payments, even surface financing options, then adapt when your approval path changes or those unusual cases pop up. Same process, fewer delays, faster cash. Teams at regional leaders like Kareem and Lean Technologies, plus hundreds more across MENA, use Okta to reduce the "where's the payment" shuffle and bring cash in sooner without forcing finance to work like product or sales. It's the kind of tool that quietly fixes the part of the business everyone tolerates but never loves. A shout out to everyone at Okta for sponsoring our episode today. Hi Jamie, what's up this week?
Yes, relatively quiet week, all things considered. But I think one of the headline grabbers, or certainly grabbed my attention earlier this week, is, as you mentioned in the intro, Ahmad, was MAGNiTT's latest Series A valuation report, looking at the emerging markets that they cover, so MENA, Africa, Southeast Asia, and there's some rather interesting charts, which maybe we'll be able to show on screen potentially. I'm putting your editing skills to the test there. I do apologize. I'm creating work for you in real time, but I do think they help. I think they help illustrate the point. So I mean, just in terms of maybe headline takeaways, UAE Series A mean valuation is 123 million. This year, that's more than 2 times growth year on year, significant. Saudi, 76 million, continuing to climb upwards. And it may be most interestingly of all is this sort of decoupling of MENA from other emerging markets, be it SEA or Africa, and that the Middle East now sort of setting higher benchmarks since COVID, essentially. So it's really sort of racing ahead in contrast. So yeah, I was struck by it. I don't know whether or not I necessarily expected that, but it'd be interesting to get the thoughts of you guys are feeling this more acutely on the ground than necessarily I am.
Let's do a gut check very quickly. When you see these numbers, the new Series A numbers. Do you feel excited or nervous?
I would say apprehensive, but I think that would sum it up.
Listen, a part of me is skeptical. I got to be honest with you because we my last job, and I've been carrying a lot of the founders after I left, and I'm speaking to a lot of people who are really struggling to fundraise, and then we see these numbers, and then I reached out to a lot of companies who have actually fundraised for a Series A, and they are doing bigger roadshows than they used to. In the beginning, you used to go down, drive down. They used to go Abu Dhabi, Dubai, Riyadh, maybe a couple of phone calls in Doha, a couple of phone calls in Bahrain. But now I'm seeing people overextend their road shows to Europe, to the US, to Singapore, and we are seeing, to your point, Dave mentioned earlier that there's a lot more international money coming into this region, so that's why I'm seeing a lot of diverse cap tables coming up with the companies that are doing, in all fairness, much better because people are adopting their technologies. I know there's a couple of sectors that really dominated this investment rounds. Fintech, this buzzword about AI also is taking a lot of that. But that is where I'm skeptical is because what is the AI definition? But I'm seeing a lot more founders open up their circle outside this region, and I think that's what the influx. I think if you drill down that 120 plus million in UAE and Saudi, I think more than half came from not from this region. But again, I'm just speculating. I still haven't seen the report, but that's my train of thought.
I think the issue for me is not the Series A valuations, it's what's happening outside those sort of massive Series A valuations. I think those big rounds that everyone hears about, sort of the mega deals, are characteristic of every single venture capital ecosystem around the world. You have to have them, they're natural, it's understandable, but these tend to be outliers. These are sort of the tail end of the curve. I think the issue is a lot more about where the bulge is, and the bulge is diminishing. Like if you look at the last 4 years, year on year, there's been a significant drop in number of VC deals. Now, that is for me a lot more concerning than it is about the valuations of 1, 5, 6, 7, even 10 venture capital transactions across MENA, and these happen everywhere. I think my concern is how the ecosystem is shaping up to be into those sort of bubble transactions, the ones that are getting all the money. You don't have sort of a super healthy bulge in the middle, like sort of the bottom of the pyramid that is very well funded. I mean, and that's the inverse of all healthy VC ecosystems across the world, right? Where you have a massive base, a massive sort of base in terms of seed and multiple investments, so, right? Like people hear about, like on the last chat, Ahmad and Jimmy, we were discussing AI generally and all the money that's gone into sort of open AI or all the others. But actually, they might be getting the news, but if you genuinely look at the VC ecosystem in the US, East Coast or West Coast, there's so much more. It's just that fine, we don't hear about it, but there is more. There's a lot that's going into all other industries. In the MENA region, it's like we get so excited about sort of the newest trend or the newest buzz industry, and then all the money goes into those top 3 transactions, but the ecosystem is not complete. And that's why I say apprehensive. It's not that those transactions in and of themselves are bad. It's what's around them that I feel is not healthy.
You both mentioned the concentration in a few industries, and it
Yeah.
seems to me that the gap between mean and median is getting bigger.
Yeah.
And there's 2 theories here. This is healthy. It's the power law market with few rockets or few really good companies, or it could be dangerous concentration where everyone crowds into the same 10 or 20 deals in the market. What do you think?
I think this is the 2 ends of the spectrum, and I think we're somewhere in between, whereby there is a sense of, I feel, a lot of concentration in the top 10 transactions that happen on an annual basis, and these tend to be the transactions where most of the VCs are in. And like you said, they do have the foreign money, which for me is sometimes scary, because if everyone remembers, in 2022, the first money that left our ecosystems when there was a slight downturn in the general VC market, it was also that foreign money, and it tends to be hot money, not sort of long-term money. Having said that, I think it isn't, I can't say it's necessarily bad. I feel it is a lot more that we need this, but then we also need more. And right now I see that we're having a lot more of those high profile transactions that are also skewed by big money that comes from sovereign funds that are used to doing mega deals abroad. And so their perception and the way they do business is very different than the typical VC. And so they could genuinely be very disruptive to the grassroots VC movement that we're hopeful to sustain and grow.
Yeah. Okay, Arnav.
Yeah, I think from our perspective, when we look at the numbers, I think it's a bit misleading because I think the median Series A, and I think I'll let the rest of the panel jump in here, it's around 50 to 75 million in terms of valuation. And most of these companies are raising anywhere between $5 to $7.5 million, let's say. And it's a bit of an awkward position to be in because you have your pre-seed and seed funds, which are, let's say, anywhere between $75 to $100 million. And then you have a lot happening Series B post pre-IPO. And then there's a structural gap in the middle, which no one's filling. And the pre-seed and seed VCs won't invest in these rounds because they don't own enough and it's too large of a check. And the Series B investors won't invest because it's too small. So what ends up happening is what Abe is talking about, where these companies have to open up the Rolodex, start looking internationally, and then Series A starts becoming this international validation round where they're looking for investors that can somehow fit into the ownership buckets that they're looking for. Sometimes the companies have to drop their valuations. Sometimes they have to drop how much they're trying to raise. But there's no sweet spot here at Series A. And I think there's a big opportunity here because these rounds are actually relative, if you look on a pre-seed or Series B basis, quite cheap, right? So there's a big opportunity here for, let's say, the median Series A that's raising into the market. If you look at Series B and beyond, there is a lot of appetite in the region for larger players to invest. So, and a lot of the Series B funding, at least what we've seen in the region, is for either regional expansion or opening doors in the region that, let's say, companies haven't explored before. So there is an opportunity for local capital to help out in that way. So what we're seeing is Series A is really this international validation round where companies have to go externally because the fund sizes internationally for Series A, or let's call it seed, are quite larger, so they can support these check sizes and valuations. That's kind of what we're seeing in the market.
I do agree with my panelists here on everything they said. So keep in mind that we've always had this gap in seed and Series A funding. We've never had, well, I never said we never. We like the B and above were always something that was easier to fundraise for, in all fairness, because these sovereign wealth funds and these big family offices and stuff like that were always interested because they were very established companies to invest in. While, I think the healthier number with all these investments coming in on a Series A just shows us that we've been working harder and harder on seed companies and the growth of the seed companies. And I think the ecosystem itself, adoption of tech and adoption of some of these deals have been becoming better and better, and people are better understanding what to invest in technology, because keep in mind there was a huge gap in the actual maturity of the investors, like your local investment houses, the local even angels and super angels and stuff like that. There's more and more of them, so there's more fueling that whole base of the pyramid in seed that is getting us to some more mature companies in Series A, which I agree with Arvin what he said. Gives them gives them that fuel to go internationally to validate their products. So I totally agree, but I think we're only going to grow from here, in all fairness.
So, Jamie, you're covering the news, you're collecting data on all of these companies. Do you think that seed is now the new Series A and Series A is the new Series B? It seems in the Middle East or in Saudi specifically, the companies, when they reach to Series A, like their growth stage already. They're big, they're 70, $100 million valuation, they're already cash rich, and everyone is chasing them. Do you see that?
Pretty much. Yeah, I think in terms of the deals that I've seen announced thus far, at least we've seen an influx of sort of, I suppose, pent up Series B deal announcements over the course of the last couple of months. We're seeing an increasing amount of sort of pre-Series A rounds. These sort of seems like sort of bridge between seed. A lot of companies doing this in particular, and they're not overly larger than your sort of your seed round in terms of the amount of money being raised there. But there's definitely been a noticeable lack. It's funny, we've been speaking, it seems like all of last year, about the Series B gap, and it turns out there's always a Series A gap all along. We just mischaracterized it. So for sure, I think that's something that's been very noticeable. And even in pre-Series A and Series A, I think you have seen an influx of to your point, it's international investors, whether that be, especially I think in a European context, I think there's been an increasing number of those that I've seen of late. But it's interesting. It seems like it's sort of like a whack-a-mole. It seems like we address one problem and all of a sudden the problem is somewhere else very,
Yeah.
very quickly.
We talked about international investors coming in, and we always in this show we say, hey, it seems that international VCs, they come here to raise money, not to invest money. But it seems 2025 is different. According to the report, at least half of the VCs who invested in these new Series A rounds are international VCs. Is this good validation that the MENA region is an emerging market that's considered hot by almost everyone in the world? Or are we creating a bubble by creating these new prices, these really high prices that are not local to the region or native to the region? Those prices are influenced by the VCs coming from other regions. What do you think?
Look, I think it's more good than bad, right? I think it's absolutely more good and bad. One, you need to mix it up. I think it's valuable to get the international investors that have done similar transactions, especially when you have GPs that are non-MENA GPs but are emerging market GPs. These GPs bring a wealth and a depth of knowledge because they've done very similar transactions. Be it Asia or be it LATAM or be it sort of Eastern Europe, and so they bring in a wealth of knowledge of having seen it before or seeing similarities in terms of the trajectory, and so it's definitely valuable. I think my only concern, or my two concerns that you've touched upon, Ahmad, are one, the valuations. Are they trying to sort of mimic valuations? And that tends to differ, right? So again, GPs that are doing emerging markets are sometimes a lot more conservative on valuations than even the Middle Eastern GPs, because they've done valuations in LATAM and across Asia that's actually sometimes a lot cheaper in terms of multiples and valuations than the Middle East, and particularly Saudi and the UAE. There are some of those that are the international GPs that are not just emerging markets, and so maybe these are the ones that slightly skew the market. But again, I feel like that's a small price for us to say the MENA region is becoming bigger and wider and a lot more open. It's not just that closed loop. It's being able to attract foreign investors as well. And so I see more positive of it than negative. I think my only second concern is this notion that it can sometimes be hot money. And so when things turn around, the first ones to run are tend to be the sort of the foreign investors, and that tends to sort of create, sort of exacerbates when we have a down market, when that money flees. But hopefully, I feel like with every new blip, like that money will flee less because they'll become resilient just as much as we've become resilient.
Love that. Arnav, what do you think?
I tend to agree. The only thing I would argue is that as long as the founders know that the regional investors are willing to pay one price and the international investors are willing to pay another, that if they take the price that the international investor gives, which is normally, for what we've seen, quite higher than the ones the regionals are willing to, they're putting a price on their business and an expectation to grow into their business that is not the same that the regionals have. So they're putting a big price on their head. So as long as they realize that there are strings that come with this money in terms of getting to the next funding round, I would say to a founder to take that money. The second thing I would say is that we're seeing a lot more companies spring up, especially in the UAE, some in Saudi as well, which are targeting global markets and not the region. So naturally, you're going to see a lot more global investors come to the region to invest in regional startups that are building globally and not necessarily regionally. And in those cases, you can somehow maybe justify the valuation a little bit more because your TAM is endless, right? It's a global company at the end of the day. You assume it's going to become much larger than just being a UAE and Saudi company. So I think over time, as you see more and more individuals move from the UK, EU, some other regions to this region and start building globally, you will see valuations increase a little bit more because inherently those companies could theoretically become bigger. And the talent that they also will hire is also global as well. And you assume might be a higher bar as well. So you can assume these companies might get larger. So that's the only two cents for me.
To that point, Arnav, and to add to this, Jamie posted a list of, I think, top 50 Arab diaspora building in the US, building globally in the US. I think if that happens, what you're saying, Arnav, happens, those diaspora will stay here and build from here globally because they can access all of these international VCs. Abe.
I agree Definitely, it's way more positive than negative. The only little thing is I've been hearing on a negative side is the founders get sometimes a bit bugged up or like really busy with hand holding some of these international investors to better understand the market, better understand how things are done in MENA. So they do take a bit more, especially if it's a first time fund for the region. They want to better understand the ecosystem. They want to, network. So they usually tag along with a lot of these founders to get them to open some doors for them. They're looking for the deal. And it is true, they do sometimes overpay, and that overpay sometimes also becomes a burden on the founder because they raise their expectations and stuff. But I generally think I would say majority is a positive because we're now considered as a also a good region to invest in. There is that maturity of both tech adoption or adoption of startup businesses as well, and we're attracting more and more investors as well. So that's in my opinion, it's like relatively very, very positive.
Let's talk about the MENA region compared to Southeast Asia. Why this decoupling? Why are we seeing way higher valuations here versus in Southeast Asia? And why their valuations are still going down, while for us in 2021, we got to a peak, went down a bit, and then we're back to those high peaks. Why do you think we have this big difference?
Money.
Okay.
A lot more money in this region. No, it
Okay,
is.
abundance. Yeah,
It's
abundance of capital.
look, I mean, let's just be honest. It's not the region, right? It's Saudi and the UAE. I mean, these are not valuations that are happening in the region. These are valuations that are happening in Saudi and the UAE. These are, I mean, is like how many of those valuations have we seen in Egypt? How many of those valuations have we even seen in the rest of the GCC, right? And so these are valuations that are
Or in
very
Jordan,
particular.
we don't see these in
I
Jordan.
mean,
Yeah.
or in Jordan or in Tunisia or in Morocco or I mean, so it's not a MENA phenomena, it's a Saudi UAE phenomena, in which case it's just a lot more money chasing some companies. And so yeah, I think for me this becomes the number one fact.
I'd also add that there's quite a lot of competition, like in for those two markets, and I agree with you, Dina. It's only Saudi and UAE, but Kaman as well. I've been seeing a lot of serious competitions of like especially family offices and sovereign wealth funds. You go to fundraise and they're you literally see in the same day other funds sitting in the lobby waiting to see these people. So there is quite a bit of competition everywhere from like from the world. They're trying to fundraise from this region, and it is true there is quite a bit of money here. But again, so we're seeing more and more of that. Hopefully, this is something that stays very healthy. But also keep in mind there's going to be competition for that money. So investors will have to give better terms. And I think for overall, it's a win-win for the founders. I don't see it slowing down for the next year or so, but I'm going to see that there's going to be a correction or some kind of like leveling because there is a bit of, I would like to say, craziness going around that specific topic. I don't know if you guys agree with me on that.
I do.
Yeah. The last thing I'd say is that the liquidity environment here, we're not there yet in any way and form, but it's maturing quicker, and you could see past the IPO. You've seen a few already. We already know a couple that are going there. If you see the big boom in Southeast Asia that happened, and if you compare it to, let's say, India, and if you just don't look at company quality, you just look at kind of the number of deals that happened and who exited, there are a lot more deals that went IPO in India than it did Southeast Asia. So when you saw the boom of both the regions, the companies that came out of Southeast Asia didn't go public, nor did anyone receive liquidity the same way that India did. So I'd say if we want to move towards the India route and not the Southeast Asia route, you just need to prioritize liquidity at IPO and exits, which I think was missing in Southeast Asia when their boom occurred.
Yeah, I wish we had more IPOs this year because we had a bet in the beginning of the year that at least 10 companies will go public this year in Saudi. There is at least 10 companies talking about IPO in Saudi, but they keep delaying it. So maybe 2027, 2028.
So that's why the jury's not out yet, right? We keep
Yeah.
hearing it, and a few are going there, but we need it to actually happen for us to move that direction.
So let's move on to HealthTech now and see what's happening in a small pre-series A.
Yeah, it's a small pre-series A, but I think worth highlighting all the same because we don't get a ton of sort of healthcare related startups. raising capital, and especially I suppose at this sort of intersection of women's health and healthcare more broadly as well. So it's Nabta Health, UAE based startup. They've raised a 2 million pre-series A, bringing total funding to 4.5 million. Founded back in 2017 by Sophie Smith. Sort of combines kind of a hybrid model. So you have your digital healthcare, at-home diagnostics, clinical services. So sort of a full stack sort of service. Sophie has been pretty outspoken as well, I would say, on LinkedIn in the last number of years with regard to, I suppose, the challenges in fundraising as a woman in the region as well. And specifically, I think in terms of getting people to believe in the company that she's building and in the space that she's building for. So yeah, I thought it was heartening to see that she'd raised the 2 million pre-series A. So fair play to her.
Amazing. I want to start with something about Sophie. Every time I go through the news, I try to research the founders. I went to LinkedIn and saw Sophie's background. On her LinkedIn, she listed mom as one of the jobs, and the company name was My Family. I love this because it treats caregiving as a real work that shapes you as a leader, not something you hide in between jobs. And as a male VC, I am aware this can sound like I'm romanticizing motherhood, but that's not the point. I just think it's healthy when founders are honest about the roles that actually define their time, their empathy, and how they design products. Curious to know, how do you see this as investors and as operators? Do you think we should be normalizing this kind of transparency on LinkedIn for both male and female founders and investors, or does it risk being judged for it?
I should be the first one to tackle
Yes,
this
please,
one.
Dean.
Look, I think it's heartwarming and it's awesome. I think it's super cool that she lists this as a job, and it is a job. I mean, I'm a mother of a 2-year-old, and it is more than a full-time job. It's the one of the toughest things I've ever had to do in my life. I've done Ironmans, and this is probably a tougher job than the Ironman. And so I think it's nice. It's heartwarming. I don't think at any point anyone didn't normalize that being a parent is a full-time job and it's very demanding. Is there value in adding it to LinkedIn? I think I could say it's half a dozen of this and 6 of the other. Because I mean, the whole idea of LinkedIn was always to say it's just the professional work. It's not that we're ignoring the personal, we're just saying it's a professional. But I think what I do certainly agree is that it is nice to acknowledge a lot more in the professional context how much your personal life shapes you as a parent or otherwise. And I feel like I do see a movement beyond Sophie of people that sort of are now using LinkedIn as a platform to also discuss personal strengths or personal experience that have gave them professional strength. And I think that is what we should generally focus on normalizing a lot more, is that to discuss professional, you can't take the personal out of it.
Dina, let me stay with you. About Nabta itself, they're doing a hybrid of an application, at-home diagnostics, and hospital partnerships. As a VC, do you get excited when you see that kind of full stack model, or worried about the execution risk and the burn?
It's a little bit of both, though it sounds like a cop-out answer, but it is really a little bit of both, right? The scalability becomes a question. Like if we just take it back to the roots of what venture capital is, it's basically it's an industry that's based around saying a $1 in venture capital can create 10 times the scale of $1 in private equity, right? Or even 100 times the scale of $1 in private equity. That's the fundamental sort of genesis of what venture capital is. And from that stems this notion of its technology, because technology is the only thing that enables you to do that. Now, there is that sort of breed of companies that are tech enabled but remain to be very operationally heavy, and those companies have unfortunately always struggled in the venture capital world because the venture capitalists do get sort of scared because they don't think the scalability is as prominent. But at the same time, they're not private equity companies either, right? But those companies tend to actually be, in my opinion, very crucial companies because they tend to be companies that are genuinely solving your day-to-day issues, right? And I think it's fair to say we have many examples of operational heavy companies that become super successful. And I don't need to say Amazon, right? This is a super operational company. It's actually a tech-enabled company because it remains to be a lot more focused about physical goods, but it's all about how do you have the technology to support. And so I feel like it's a model that more and more VCs are unfortunately shying away from. But I think with the right execution, it could be a good company. And when it's that with the at the intersection of also health tech, for me, I find it to be a company that is very that speaks to me, right? It might not give me the 100x multiple, but it could still give me a 5 to 7, 10x multiple, which I also feel like in a VC portfolio construction is something good to have. It's good to have those companies that can give you a 5 to 7, but then also the ones that give you 100, because the one that give you 100 more often than not, it's either 100 or 0.
We keep discussing that specific point internally in Sado Capital. Should we invest in tech startups or tech-enabled startups? And we're still discussing that, but I wrote a long blog post about this. I titled it, "You're not a tech startup anymore. That's okay, but." And the but here is all about what kind of capital you should be chasing. Is it venture capital or private equity or debt, or what would be
Or
more
maybe
suitable for you?
angels.
Or maybe
Yeah,
angels.
sometimes angels are fantastic to fill that gap.
I do agree that angels would be great to fill that because they understand it's more of a business play than a VC play, in my honest opinion. In all fairness, even from the investments that we've done, the tech-enabled ones always did way better than tech. Maybe because the ideas were the tech adoption rate wasn't as fast as the tech-enabled ones, so that we saw growth. And I think we had the same conversation maybe 4 years ago when we talked about cloud kitchens and all these tech businesses. Is it a tech? Is it a non-tech? Is it a traditional business? I think, but with adding the whole femtech and all this link to health, I personally, this is me, Abe speaking, not anybody. I always struggled with health tech companies adoption, especially. I'm not talking about the funding rise, but I'm talking about building the product and adoption because these are also people don't talk about regulation about health in general. When we talk regulation, we always think of fintech and we always think of mostly fintech, and so health was always a very difficult space, and to add that whole femtech on top of that just made it more and more. I am seeing more and more founders in that space coming up with building something that is exactly what Dina said, very operationally heavy because there's a lot involved in it. I generally think there is a space for them, but I don't know if it's a VC play. That's because VCs usually have some a playbook they follow or something that they've written themselves. So that's something that we're seeing more and more, and I'm hoping more angels, especially angels from those sectors, the health, come in and actually fill in that gap because there is quite a bit of money there.
I think it's sector specific. So I think healthcare is one sector in the region where there needs to be a hybrid or physical component to it, right? There's a higher level of trust when you can physically go and see a doctor or go do a test. So building something that's stack or that has some sort of hybrid model does make sense for healthcare. And you can't force software just to get a higher multiple if it doesn't work in a sector, right? You need to adapt yourself to how the sector works. From what we've seen from the healthcare players, whether femtech or not, is generally CAC is quite a bit on the higher side. So if you build out a full value chain or a full journey and you can monetize at multiple touch points in that journey, it's easier to build a sustainable business in the healthcare space. So that's why I kind of the idea of why they're going for kind of a hybrid full stack approach versus just a single telehealth solution or a single product or going towards a single sort of product.
Do you think they should have raised more, Arnav, if they're going after this model?
I mean, more money is always better. I don't know.
Okay, let me
the 2 million
rephrase. Do
was.
you
It's
think
a pre-series A.
Yeah, pre-series A. Yep. So the last thing I want to ask about this company, whether it's Nabta or any other health tech company, how should founders approach the AI factor? I know we all hear AI, it's a buzzword, but in health tech, Abe, you're not a big fan of health tech. How can founders present the added value of AI in their processes, in their operations, in their product offering, without sounding like they're just adding it as a buzzword?
From my perspective, look, we've seen AI across different industries do two things. Either you're increasing your revenue or you're decreasing your costs, right? And there's a clear ROI that's attributable to that. From what we've seen, the revenue sell is always a little bit easier, but if we're looking at healthcare, I would assume it's more on the cost optimization side. So whether that's more accurate diagnostics or whether that's increased number of throughput on patients, whatever it might be, if you put numbers on the board where you can specifically explain, I'm using AI to do X and it's leading Y in results, I think that's the easiest way to try and explain it. I think you're always going to see AI being used in pitch decks now because every AI has to raise, and every company is an AI company to a certain extent, right? You'd be stupid not to use it. But it's a question of to what extent are you using it and what are the results of that and how is it impacting your business? And if you could put numbers on the board that explain that, I think you can make a decision for yourself and it's clear.
I slightly differ from Arnav. I think someone has to draw a line as to when a company can claim it's an AI company, right? Using an AI tool does not qualify you as an AI company. And I think
I
health
can
tech or
come back
not,
to you with the same terminology, Dina. Is it AI company or AI enabled company?
exactly. But that's exactly it. But a lot of them just say we're an AI company. It's not an AI company. And I think health tech or otherwise, I think a lot of founders do themselves harm if they claim they're AI and then I as an investor go dig in and it's not an AI because there's a letdown. I'd much rather someone come and tell me I have a super cool stack, come check my tech. And I come and I find it's actually fantastic and there's some AI in there rather than sort of managing expectations of an investor that say I'm an AI company and then there's like an AI tool that's being subscribed to, right? It's like peer pressure. I don't feel that every single company needs to claim their AI. It's unfair. And I feel like that is actually my biggest woe. It's not that I feel bad or it's not like I'm mad at the companies that claim their AI. I just feel bad about the entire sort of ecosystem that's created that massive pressure that you can only raise money if you embed the word AI in there somewhere. And again, I think it takes me back to the question that we had earlier about like sort of the VC funding and the average. I think it's just because all the money has gone into AI, founders and startups are feeling a lot more pressure to say, if I have a chance to get someone's attention, I need to say AI. And it shouldn't be that way. But yeah, I think nonetheless it is essential. I would recommend for every company and every founder to try and be as efficient as possible. There's no denying that. Like a big part of being a good founder is to say, how can I cut my costs? And most of the AI the AI components you see now is about what Arnav is saying. It's the former. It's trying to reduce your costs, it's being more efficient. How do you automate processes? How do you sort of minimize, like as a company that's health tech, I think there will be massive value in her saying, if I already as apprehensive as an investor in terms of how physical this business is, showing that I'm able to eliminate 50% of it to be done by the machine rather than being done by a human is absolutely valuable. And I think there is definitely value in having more health tech companies look at AI so that they become a lot more interesting for VC.
Abe, you mentioned GPs fundraising. Should we, as GPs, start saying AI as well? AI funds,
One of
AI
my
VC
partners
funds?
is a robot.
Yeah,
Yeah.
yeah.
I love that.
On a separate note, there's quite a bit of these new terms with AI, like I'm seeing AI board members and stuff like that. But going back to that point, it is true that a lot of people are just dropping the word AI, thinking this is a part of their secret sauce. And it is an efficiency workflow play. Honestly, like most of them are like, as you said, that, I asked them like who wrote the code, who wrote the algorithm, and they'd be like, oh no, we borrowed something. And I'm like, I so you're not an AI company. And my other issue with AI is where's the data from? Like a lot of people say we're going to get, so much more efficient. We have our own LLM. Okay. And then I ask, where's the data populated from? And a lot of these companies don't have enough traffic for them to build an LLM, right? Like, so, just I think this month alone, I spoke to a couple of companies, that they literally have less than 1,000 active users. So I don't know how, like their LLM would not make any sense, or they claim they have an LLM. So it's sometimes you just want to talk to the founder and say, I really want to look under the hood to see what is really AI to you. But I think in personally, like from experienced investors, if you say you're more using it for workflow and for efficiency and to drop operational costs, for investors, that's even better music to our ears than actually saying I'm just using AI. Like, because AI can be because you can go the other route and saying, okay, where's your GPUs? How much are you paying? And blah 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 blah. And that is actually more of an inflated cost than the other way. So it's I think it depends on A, the level of the company, at what level they are, and B, what is the real definition? Because now I started asking people like, what is your definition of AI? Like I want to know, how do you incorporate it in your business, and what does AI mean to you? And you'll hear all kinds of weird stuff. And again, it is a buzzword. A couple of years ago it was blockchain. Before that it was, you know what I mean, like, so that's something that is very key. And the thing is, healthcare has tons of data, and people don't know what to do with that data. That makes more sense on an AI LLM play. But then again, I feel there's also a disconnect because there's a lot of legacy tech in healthcare that needs to really modernize and stuff like that. So that's why healthcare is kind of messy. And that's, again, I'm not saying I don't like it, but I'm just saying it's not for me. You know what I'm saying? So
Yeah,
that's how it is.
understood. So if I want to summarize the points that the three of you mentioned, so Arnav, you focused more on the metrics, how using AI would affect your metrics, so quantify the effect of AI in your company. Abe, you mentioned data. What kind of data are you bringing there, and who actually created those AI models or the code? And Dina, you focused a lot on how much of the work is moved from human to a machine. So these are really good points where you can really explain why AI is a good part of your company as a founder. So let's move now to another industry, PropTech. Jamie, what's happening in PropTech in Saudi?
Yeah, we look at something maybe not as equally buzzy, and I believe they don't actually make reference to AI at all in their press
Yes.
release, which is an exception to the norm at present. So this is Ghanem. Am I pronouncing that correctly? Is that a horrible pronunciation? Do I get a pass?
You're doing all right.
Oh, yes. Okay, brilliant. Okay, I won't repeat again for fear I screw up a second time. But in any case, they've raised $7.1 million from the Al Romai group. Seemed like a sort of conglomerate in Saudi across a variety of different industries, from manufacturing to, I think they've some sort of real estate offering, and I saw paint in there as well. So a true sort of family conglomerate in every sense of the word with regard to the industries which they traverse. But very young company. I believe they only launched earlier in 2025. I don't know what the mix is as well. Sorry, in that 7.1 million of whether that's equity or whether there's an element of debt. I've no idea what the story is, or necessarily what the involvement of the Alumni group is, either in terms of an ownership side of things. But they do claim that the support of the partnership with Uruguay is going to help. As I mentioned, they do have some sort of real estate offering, so whether or not it's sort of taking some of that existing and fractionalizing it, I don't exactly know. But it's starting to become a relatively competitive space. Not so much in a Saudi context. I know Stake expanded there relatively recently, and they have a presence, and more broadly regionally we have Pripco, obviously, who are doing the tokenization side of things, and big backing from General Catalyst recently. And then obviously Naui, who raised quite a large Series A of late too, and who are active in the UAE now as well. So it's a yeah, exactly. So it's an interesting space.
As a VC, my friends think I'm a really good financial advisor. I am not, by the way, just to put it out there. Many of my friends keep asking me, should we invest in fractional ownership or not? And I don't know what to tell them. So that's why I brought this question here. There's two sides for this, right? So one view is fractional ownership will deepen the capital markets and help create wealth for individual investors, right? Because they wouldn't have access to this asset class if it's not for fractional ownership. And the other side would be, no, it's risky because you're pulling the retail money into an illiquid and hard to price asset class. Where do we go from here? What do you think?
Well, I'm hoping to speak to Rami from Stake next week, so I'll ask him.
Please
So
do.
that'll be my that'll tide me over. I have no. I'll wait. I'll get the expert's viewpoint on this. But yes,
I really like the guys from Stake as well. Like I like Rami and I like Nar and I generally think it's something that is this is a business class that's growing. I think they're bridging the gap, fueling their engine from another source of cash, which is great. That retail, investor slash. I think we're gonna see more and more of those businesses pop up. And I don't know how successful because the real estate market as well is getting to a level where they have to source better, obviously, products to put on their website. So it becomes a more of a challenge. Of that, I do predict there's going to be another 2 to 3 more players in the next year or so coming into this region as a diversified asset class. I personally use Stake as well, so and another company in the US. So it's a asset class that people are really, I think, real estate has always been an easier sell than anything else so I think transitioning into that asset class would be much easier in my honest opinion.
Yeah, I think
We got a
I
very
would.
diplomatic answer from Abe, so maybe you can give us more direct.
I said
No, no.
I said I like it. Come
Yeah.
on. Like,
Yeah, you like it.
I'm trying to
Kidding,
be
I'm
less
kidding.
diplomatic, but it's fine.
No, I think it's necessary. Look, I don't think there's a single investment that doesn't have a risk component to it, right? And I think if it's retail that understands it, that signs up to it and reads the tiny print, then it should be fine. And I feel like in our part of the world, I mean, and in many parts of the world, I mean, honestly, individuals are only investing in real estate or gold, right? And so making it amenable or making it accessible is fantastic. And the truth of the matter is that actually the more people come into the fractional ownership, the less risky it becomes, because it doesn't become that there are two people trying to sort of be backed or ownership into a bigger investment. When it's more people, it's actually less of a risk. And so I think it's valuable. I think it does give people access to an investment, like the average person gets access to investment formats beyond the banks or just simple long-term deposits. And I think it's again, it's not new. This existed around the world for years now, and especially if you work at that these are funds or REITs, or then it becomes even less risky. And so no, I personally think as long as someone has the right licensing in place and the right mechanics in place and someone that genuinely understands how that business works, I think it's great for the region. Because I also feel like if individuals, I think there's a ripple effect that will come out of it, right? Like if individuals start looking at investing beyond just putting their money in the bank and making returns, they become a lot more incentivized to look for alternative investments beyond just sort of deposits.
Yeah, look, I agree with everything both Abe and Dina said. I think it's a net positive. The only thing I'll say is that this model monetizes extremely well, and you get those fees over the life cycle of the property. So, SPV setup, entry fees, the rental, secondaries, exit. So there's like 7 different ways that Stake or any other real estate player can monetize. And if you start doing the calculations, like it actually impacts your returns quite a bit. So as long as you go into it knowing that these companies are taking a chunk of the capital for you getting access to something that you didn't have before, that's fine from my perspective. But if you compare it to just traditional stock trading or traditional other asset classes, the fees are quite high. And there are a lot of competitors coming in. So my hope is over a period of time, the fees compress as it gets more competitive. And I think naturally that will happen. The model in Saudi, I know, is a little bit different than the model in the UAE because it has to be a fund, or I'm not exactly sure on how it works. And the fees for the fund are also, I think, quite high. So look, I think overall it's a net positive. You get access to something that you didn't have, as long as you realize that you're paying quite a bit in fees compared to any other asset class if you wanted to trade fractionally like stocks or crypto or whatever it might be.
The last point I want to raise here is sandboxes. We've seen sandboxes in fintech, now in PropTech, maybe some other verticals. What do you think of sandboxes? Because some founders say, okay, they're helpful. Governments love them because they make sure that everything is according to the latest regulations that they have. But some founders hate them because they slow them down. Some would take a year, a full year, maybe more, to graduate from a sandbox and get a license. What do you think in general about these sandboxes?
Can I start this? Because I have
Yes,
a
please.
very
Whoa, it sounds.
aggressive word to say. I think sandboxes are the new accelerators. Honestly, I think it's like the new excuse to like push people into another alley or chore. So, and I have not seen a sandbox that is super progressive. I know some of them are trying, and I know it's bringing, bridging the gap between usually a governmental ecosystem play with our ecosystem. But come on, like putting people for 12 months in a sandbox, what are they going to see that they're not going to see in 3 months? Do you understand what I'm saying? Like within 3 months, you can really see if this is going to work or not. So why would I have to sit in a regulated box for 12 months minimum? Like I'm seeing even, again, I swear I'm not picking on healthcare today, but I'm seeing a healthcare regulator or sandboxes that are 2 years, 24 months. And, I understand patient care and, it's more sensitive and stuff like that. But 24 months for a company to sit in with these guidelines will really demotivate a lot of the founders and on the team, and I don't know how much growth they can do. So that's something that um, I feel very strongly against that aspect. I believe they need to be there, but I think they just need. I think a lot of people just wanted to put something in a box and then they called it a sandbox, but they just launched it and then never reiterated or tweaked it or came in and like what we say, like really optimize the offering. And that's what I right now I'm struggling with. So I don't know if I
Fully agree. I fully agree, Abe, because I've seen fintech companies in a sandbox for 12 months with almost zero growth. They're not doing anything, not because they don't want to, they want to grow, they want to sell, but they can't because of these regulations. And they only can after they graduate. I think I fully agree with what you mentioned in the beginning. It should be only a 3 months process. Force them to do whatever you want when it comes to regulations and cybersecurity and everything, but release them early. Let them grow. Let them go and sell.
yeah, put them on some KPIs. If they don't hit certain KPIs, they can leave the sandbox. Adi, it's very simple. Like it's just that's what my train of thought.
I think just to add one last point, I think sandboxes are not meant to be to drive growth. Sandboxes were created, or the whole idea of a sandbox was for regulators to test the technology before they're able to approval. And so it shouldn't act like I'm trying to support a company to grow. It's actually a lot more to benefit the regulator. It was meant to be as it's something that is meant to benefit the regulator to get comfortable with the technology, to ultimately then benefit the founder because he gets regulated and is able to sell. But then I agree, it became like Abe, it became an accelerator, but it shouldn't be. It was meant to be that sort of, it's just a physical testing space as opposed to a development app testing phase, and I think that hasn't really materialized.
Agree with everyone, and I should also say that once a regulation is written or you have precedent over similar startups that have launched, then the sandbox should close, right? Because what you're seeing now is, let's use a very simple example such as real estate, fractionalization of real estate. They might have a sandbox for it, or you can go out and raise capital, let's say $3 million, I'm making something up here, and go out and then get a full license. Both take time. It's just a question of capital or no capital, and it's a question of limits versus no limits. I think both have limits to a certain extent. But once there's the regulations written and there's precedent, the sandbox for that sort of business should close.
Before we wrap up, a big thank you to Okta for making today's episode possible. If you're tired of chasing payments, fixing invoice errors, or wondering where the cash actually is, you need to check them out.
They help you get paid faster, access financing when you need it, and automate all the messy parts of receivables that no one really wants to deal with. They're already working with over 800 companies, and for good reason. It's one of those tools that just quietly makes your finance ops work. So head over to weareokta.com, that's weareokta.com, and see why so many businesses are switching to the modern way of getting paid.
With that, thank you so much for joining us today, Arnav, Dina, and Abe, and we hope to see you soon again. And thank you, Jamie and FWDstart, for getting us all the stories every week.